In terms of cost, one big item on the phasing out of industrial building allowance. Buildings are expensive. This is a big dollar item. Salaries and rental are usually the two largest components in your P&L. And building owners basically fork out quite a lot of money to own property. Of course, we have no capital gains tax, but let me just give you a specific example. If you buy a 10-year lease, or 7-year lease, 30-year lease, and in the past, if you qualify for industrial building allowance, you get a so-called tax deduction. That is going to be phased out. And unless you carry on certain activities in one of the 9 sectors, your building costs will no longer be allowed going forward. And I can tell you, let's use a wet market, a 14-year lease, a 7-year lease. You buy your wet market, let's say you are the businessman. Who do you lease out to? The tenants who will sell you and I vegetables when we go to the market. If he buys it for 10 million and he collects over the period $12 million of revenue, his 10 million is of no deduction because we are phasing out. Anyway, by the industrial building allowance is not, what I'm trying to say, wet market is not allowed anyway, but let's take the example. If for someone like him, the 10 million is not deductible, the 12 million is subject to 17% tax. What I'm trying to say is, IBA is a big item, properties is a big item. Industrial building was for industrialization. I was quite happy that MOF looked at parts of the act to phase things out, but instead of making it easier, to me, it is a whammy. It's a whammy for businesses when they phase it out totally.
So what would your suggestion be then? What are you asking? Just keeping it? Or, I mean, what would be a better...
It would have been better if they are more focused on think of ways to allow businesses to claim tax depreciations on big item, taking into consideration that there's no capital gains tax. So if you buy a piece of land, it's freehold, you build a hotel, you run the hotel. If you don't give the hotel a claim, I understand, because hotel players maybe look at their land appreciation. But if you have a 10-year lease, a 14-year lease, to do anything there, and you are not allowed any claim on the building, that will increase costs. That cost will be passed on to businesses, which will be passed on to individuals.
I speak for Sanders because we're in the real estate business, and I think that point is a very valid one. The fact that we build business space, business parks itself, actually specifically for R&D and industrial businesses, taking away the IBA, which is in itself currently very restrictive as it stands. But to take it out totally means that we actually raise the cost of doing business for the exact industry that we're actually trying to promote. I think other point that I would like to raise here is that the clustering effect that you have, even for some promoter industry, in a business park, it's not possible for us to have entirely all the specific sectors that you want to promote in the park, for 2 reasons. One, there's a supporting industry that needs to go along with those that you do support. And I think the other point that is worthwhile noting is that the gestation period for us to fill the park, specifically if you build up 1 million square feet of space, takes time. And that means in the interim, business park developers like ourselves, who has to still make it commercially viable, will have to fill those space up with interim users of those space. Even that is a challenge. And so if we were to actually ignore that fact, what will happen is that not only have you taken away the IBAs, you actually now say that it's very hard to qualify even for the other new scheme that we have, which is the Land Intensification Act. And I think that part we need to address more carefully. Otherwise, we will actually see cost of doing business actually go up, even for the promoter sector.
Speaking on behalf of the Esplanade, whilst we welcome the reduction in withholding tax for non-resident public entertainers from 15 to 10%, I'm just wondering whether we could look at a tiered sort of a tax as well. I understand that some jurisdictions have a different tax, different rate for commercial groups and then for arts groups. So I think if you look at the cash flow, a presenter like the IRs will have a very different cash flow from, say, some of our local arts groups. So I think it would help if it could be differentiated. Yeah, it would help the arts groups. Thanks.
Singapore is a global and Asian hub. I think in the Economic Strategies Committee, I think the message was anchoring Singapore as a global and Asian hub. In the recent budget, is talking about growing Singapore's role as a global business hub. I think one of the key things that we may want to look into is that to start off in terms of being a business hub, one of the things we should do is to make Singapore an even more attractive place for basically multinationals and even local companies going out to base their headquarters over here. I know we have some of these incentives in terms of the headquarter incentives, that are pretty useful, particularly when we are looking at that. Again, I have to mention in competition with Hong Kong, Malaysia has adopted a lot of the scheme in relation to what Singapore has to make themselves competitive. But of course, there are certain reasons which Singapore is favored over Hong Kong and Malaysia. The biggest threat I see is actually Hong Kong. And to make the scheme, the situation more attractive and the position for headquarters being here and therefore Singapore becoming a hub as a part of that, would be to basically provide greater flexibility in terms of the repatriation of income for companies which have in Singapore, headquarters in Singapore, which have funds from their overseas investments and subsidiaries and the like. Last year, I think, there was a one-year transition period to allow foreign income to be repatriated. I think that was actually pretty beneficial because of the crunch at that point in time. Now, taking it into a longer perspective, perhaps this could be extended for more years, maybe over a 5-year period, or at some point in time remove altogether the restrictions so that we are put on a competitive level with Malaysia and Hong Kong. If the concern is that there may be avoidance of tax in terms of liberalizing it too quickly, then maybe a sort of another extension over the 5 years with some inland revenue approvals could be the transition measure. But I think overall, in the longer term, I think that's pretty important because actually, in reality, when companies based over here, Singapore is used as a managing center for their treasury functions, their finance functions. So they bring in funds from all over the world, in the region, so that they can redeploy them into countries where they are actually expanding. So the repatriation and managing of funds is actually an important aspect, and it actually serves our purpose because we're trying to build up expertise in that area as well. So I think this kind of incentive would actually go quite a way in helping the situation and particularly anchoring us as a hub and a center.